Hey everybody, welcome to Banter City, and today we'll talk about yield curves. So, yield curves are basically a plot of duration and interest rates of government bonds, which are called treasuries in the US. So, here you have it for India. As you can see, it's almost flat. And as the conventional wisdom goes, if you're gonna buy a bond for a long duration, you'd obviously expect higher yield or higher coupon rate or higher interest rate to be paid to you. And similarly, if you're buying a bond for a shorter duration, say 6 months or 1 year, you would not expect as much. That's the convention anyway. But there are situations in economics where the convention doesn't always work. There could be certain scenarios when inflation runs hot in the short run, because of which the short term treasury yields can spike. Since the short term bonds yield very less, people start dumping it, due to which and start because people think, okay, short term the condition isn't going to improve, but in the long run it will improve, so they all start buying long run bonds, and the yield curve could invert or perhaps go flat at the very least. And that's what we're witnessing right now. As you can see here, so 6 months bonds or 3 months T-bills are giving 6.9% in India, whereas 6 months ago it was just 5.66%, and 1 month ago it was just 6.68%. So 3-month bonds, 3-month T-bills themselves are a great investment at this point. And then you go for 1 year maturity, and 1 year bonds are giving 7.344% coupon rate, or I mean to say yield. And then as you go down the line, 40-year maturity bonds are giving 7.49. So there's very little difference, only a difference of say 15 basis points between 1 year and 40-year, and that explains it. So that is how much uncertainty is in the short run because of inflation and quantitative tightening. But you never know, it could come down, it could come crashing down anytime. And if you look at the 10-year, it's 7.429, and if you look at the 1 year, it's 7.34. So just a difference of 8 basis points. Now if the 1 year bond starts spiking, that could very well be the yield curve inversion for India. India is placed in a much better position compared to US at this point. If you look at the US yield curve, the US government bonds yield curve, it's already inverted. As you can see, the 1 year bond or the 6 months bond itself is paying 5.12% compared to the 30-year maturity treasuries, which are paying 3.37. So that's much less, almost a difference of roughly 140 basis points. And if you look at the 10-year treasuries, they are paying 3.71%. So the yield curve has inverted, and typically the yield curve inversion is associated with a recession, but it's not. It's considered as a leading indicator of recession. However, you never know. Yield curve inverts because of some macroeconomic conditions like inflation running amok, or relentless quantitative tightening. But if these conditions reverse, if inflation cools down and stuff like that, there is a high chance that the yield curve could flatten or even become normal. So yes, there is a high probability of a recession, but we can even avoid it because ultimately the yield curve is only the behavior of the markets, and when data changes, the market participants will adjust their bets accordingly and incorporate the new information into the yield curve, thereby making it suitably priced. So that was all about yield curve, my friends. As you can see, this is the duration and this is the interest rates or the yields. So yeah, looks like maybe short-term bonds might be a good opportunity to make money, but you never know. And this is not financial advice, this is just education. Thank you for watching. Cheers.